1.2 Key Terminology in Options Trading. To fully understand options, it is essential to know the key terms. They form the foundation for every trading strategy and for valuing options. Let's go through the most important terms one by one. First, the underlying asset. This is the financial instrument on which the option is based. Next, contract value. It represents the total value of one option contract. Then, option premium. This is the price paid by the buyer to the seller. Expiration date. The last day on which the option can be exercised. Strike price, the fixed price at which the underlying can be bought or sold. Time to expiration, the remaining time until the option expires. Intrinsic value, the amount by which an option is in the money. Time value, the portion of the premium that exceeds the intrinsic value. And finally, volatility, a measure of how strongly the price of the underlying asset fluctuates. These are the essential concepts that form the basis of every option strategy. Underlying asset. The underlying asset is the financial instrument or asset on which an option is based. It can be a stock, an index, a commodity, or a currency. The price movement of the underlying directly affects the value of the option. Example, if an option is based on Tesla stock, the Tesla share price determines the option's value. Contract value. The contract value represents the total value of an option contract. It is calculated by multiplying the current price of the underlying asset by the contract size. For stock options, one contract usually represents 100 shares. Example, if the stock price is $50 and the contract size is 100 shares, then the contract value equals $5,000. Another example, a buyer of a call option on Tesla stock secures the right to purchase 100 Tesla shares at a specific price and on a specific date. Option premium. The option premium is the price of the option that the buyer pays to the seller, also known as the writer. It is made up of two components, the intrinsic value and the time value. The premium fluctuates depending on several factors: the price of the underlying asset, the volatility of the market, the time remaining until expiration, and the interest rate. The seller receives this premium as a reward for taking on the risk of the option contracts. Expiration date. The expiration date is the final day on which an option can be exercised. After this date, the buyer's right to exercise the option expires. There are two main types of options in this regard. American options, these can be exercised at any time before the expiration date. European options, these can be exercised only on the expiration date itself. Strike price. The strike price is the fixed price at which the underlying asset can be bought in the case of a call option or sold in the case of a put option. It determines the level at which the option becomes profitable or in the money. Time to expiration. The time to expiration refers to the remaining time until the option's expiration date. The longer the time to expiration, the higher the time value of the option, because there is more opportunity for the underlying asset's price to move in the buyer's favor. Intrinsic value. The intrinsic value represents the amount by which an option is in the money. It is the difference between the price of the underlying asset and the strike price. For call options, it is the underlying price minus the strike price. For put options, it is the strike price minus the underlying price. Example, if the stock price is $110 and the strike price is $100, the call option has an intrinsic value of $10. An option has intrinsic value only when it is in the money. The intrinsic value can never be negative because the holder of an option has the right, but not the obligation, to exercise it. Therefore, the lowest possible intrinsic value is 0, which occurs when the option expires worthless. Time value. The time value represents the portion of the option premium that exceeds the intrinsic value. It reflects the probability that the option will gain additional value before expiration. The longer the time remaining until expiration, the higher the time value, because there is more time for the underlying asset's price to move in a favorable direction The time value gradually decreases as expiration approaches. This effect is known as time decay or theta. The time value is often called a risk premium, as it compensates the option writer for taking on the risk that the underlying asset may move unfavorably during the remaining time to expiration. It can be calculated as the difference between the option price and its intrinsic value. The time value prices in the risk of volatility over the remaining life of the option. The greater the volatility and the longer the time to expiration, the higher the time value. The time value of an option is important because it directly influences its total price. Even if the intrinsic value remains constant, the time value drops sharply as the expiration date draws closer. In classical option theory, theta measures the daily loss of time value. Theta is always negative and is largest for at-the-money options. As expiration approaches, theta increases in magnitude, causing the option's time value to decay faster. Volatility. Volatility measures the expected degree of price fluctuation of the underlying asset. It reflects how much and how quickly the asset's price is likely to move over time. Higher volatility leads to higher option prices because the probability of the option ending up in the money increases. The volatility of the underlying asset has a direct impact on the option's price. The more volatile the underlying asset, the greater the potential price swings, and the higher the risk of trading that asset.
Thanks for watching. If you enjoyed this video, please leave a like, subscribe to the channel, and share your thoughts in the comments. Stay informed, stay rational. See you in the next one.